We'll go ahead and get started with one of the exercises, which is number 11 here. Okay, so in exercise 2.1, we are going to be classifying accounts as either assets, liabilities, or owner's equity. So the first account is cash, which means how much money is in the bank. Businesses typically do not leave cash lying around the office. They complete their financial transactions using a checking account. So cash in the bank is an asset. The definition of an asset is anything that is going to provide future benefit to your company. So we're going to choose asset from the drop-down menu. Office supplies also provide future benefit for the company. So we're going to enter that as an asset as well. Okay, money owed, and a typical account that shows the money owed by a company is accounts payable. So anything owed by an organization is called a liability. Office chairs. Okay, so office chairs are also an asset because we are going to use those chairs over and over and into the future. We're not going to just use them up and then they'll be gone, and then we'll buy some more. They're an asset because they will be continued to be used and provide benefit in the future. The next account is the owner's capital. Now remember that there are 4 accounts that fall under the equity umbrella of a business. So owner's equity consists of capital and drawing, revenues, and expenses. The definition of capital is the net worth of the owner, or either any investments that are placed in the business by the owner. So if the owner of that business adds $1,000 cash out of his personal account into the business checking, then that is an investment by the owner, and that's considered capital. So your capital is your net worth or any investments, and that falls under the owner's equity category. Money withdrawn by the owner, which is called the owner's drawing, or the case here is John Smith drawing. When the owner takes assets out of the business for their own personal use, that's considered the owner's drawing. That happens all the time. If you open up a business and your business is earning money, you're just not going to leave all the money in there in the business. You're going to want to draw some out because that's why you're in business. So that is not a salary to the owner, but it's called drawing. So it is also under the owner's equity. And then money owed by customers, and the account here is accounts receivable. So accounts receivable is any time that we do work for a customer or provide a service or a product for a customer and they don't pay us at that moment. We send them a bill, and that happens quite often in business as well. You'll send them a bill and they'll have 30 days to pay. So if you don't receive the cash immediately for providing a service, you call that accounts receivable, and that falls under the assets. So now that we've got all our answers entered, we can click down below, check my work, and it will show the answers that we got correct and the answers that we got wrong. So it looks like everything's correct. So periodically you might want to save your work. It says all work is saved, but just make sure before you exit that you save your work and exit. Okay, let's go to the next one. All right, here it says using the accounting equation, compute the missing elements. Okay, so if your accounting equation is assets equals liabilities plus owner's equity. So if we are given two of these elements, we're able to figure out the third because they have to balance. So for example, I can add 27 and 17. Okay, so my answer there is 44,000. Okay, in the next one I have 32,000 in assets, 18,000 in liabilities. So how many more do I need to bring this 18,000 up? How many more do I need in owner's equity to bring the 18,000 up to 32 to equal the assets? So for that one, I'm going to take 32 and subtract out 18. So that answer is 14,000. All right, and the last one, we've got assets of 27,000. The liabilities are missing. We've got 20,000 in owner's equity. How much do we need in liabilities to bring the balance up to 27? So looks like we need 7,000. Okay, and I'll check my work, and everything is looking good, so we can move on. Okay, so in this one, John Sullivan started a business, and his first month of business was February 2020. The following transactions occurred. So we are going to show the effect of each transaction in our accounting equation. All right, the first one says that the owner invested cash in the business of 27,000. You're going to see this transaction many times in this course. So when the owner puts cash in the business has two things now. It has cash, and it also has an investment by the owner that needs to be accounted for. So cash, as we learned in the previous problem, is an asset. So we're going to increase our assets by 27,000. The other account is capital. When the owner invests assets of any kind, whether it's cash or a piece of equipment, when they make that investment in the business, it goes into the capital account. And capital is one of the four accounts found under owner's equity. Remember, we have capital, drawing, revenues, and expenses. So our owner's equity has now gone up. Owner's equity is what is left after, say, if a company sold all its assets and paid off its liability. The owner's equity is what would be left, or what belongs to the owner. Okay, so just kind of keep that in mind. That's also called the net worth of a business. Okay, then the system wants us to balance out. So all we're going to do is bring the 27,000 down to the balance line, and then also under owner's equity, we're going to bring that balance down. In B, it says we bought office equipment on account. Okay, so the two things that occurred with this transaction, and remember, you're always going to have to find two things at least, or your accounting equation will be out of balance. Okay, so now I bought office equipment. So now my business has more office equipment. So I'm going to increase assets because office equipment is an asset. Whoops. Okay, 7,500 under assets. And then how did we purchase this? It's on account. That means we've bought it and we're going to pay for it later. So that means that we owe it. So let's put in the 7,500 under liabilities. Remember, liabilities is anything that we owe. So now our assets went from 27,000 to 34,500. Just add those two transactions together. We now have 7,500 in liabilities and we still just have $27,000 in owner's equity. Okay, and notice if we add the $27,000 plus the $7,500 in liabilities, we're going to equal our assets of $34,500. The accounting equation always has to be in balance. In transaction C, we bought office equipment for cash of $1,600. Okay, so it says enter the change in cash on the first line and the change in equipment on the second line, and I'll tell you what that means. First, let's look and figure out the two accounts that were affected in this transaction. First, we got more office equipment, just as we did in B, because we bought office equipment, and we know office equipment is an asset. So we are going to increase our assets for $1,600. How did we pay for this equipment? Well, we paid cash. And if we paid cash, that means our cash balance went down. So it says enter the change in cash on the first line, which we will. So cash went down by $1,600, and then office equipment increased by $1,600. So technically we really did not have any change in our asset balance. We started with $34,500, subtracted $1,600, added it right back, so our assets are still $34,500. Our liabilities did not change. They're still $7,500, and owner's equity remains at $27,000. Okay, next in D, we paid cash on account to supplier in transaction B. So let's check out B. In B, we purchased office equipment and we paid for it on account. Okay, so D is telling us that we paid this cash on account to this supplier when we bought this equipment. So you know when you get billed, you have to pay for it. So we're going to pay with cash, and cash is an asset, so we're going to be under the asset column. And it looks like that was a $2,300 payment. Okay, so cash goes down and our liability is also affected. So if we owed $7,500, we paid on account $2,300, then our liability is also going down. Okay, so if we rebalance our cash, we're at $34,500. We take out $2,300. Now our balance is $32,200. Our liability is now $5,200, and our owner's equity was unchanged. Okay, so let's check our work, and everything looks good. Sometimes if you have an X, it might simply be due to you're not putting the minus in. So check that first, and then just kind of keep working until you get the correct answer. Let's move on to exercise 4. Now in this, we're going to be working with some more specific accounts like capital, drawing, revenues, and expenses. So you will have several more problems very similar to this, where all your assets are broken out. Your liability account will be accounts payable, and then you'll have all 4 of your owner's equity accounts listed as well. So on E, our balances from our previous problem were brought over, and so now we're going to enter this transaction. We received cash from a client for professional services. Okay, so what 2 things do we need to record for this transaction? The first thing is that we received cash because our cash has changed. So our assets are going up because we received the cash. The other thing is that we have performed a service and earned a revenue. So we need to keep up with how much revenues we actually earn in our business to see how well we're doing. Okay, so under E, I'm increasing the cash under assets, and then the revenue is for $1,500. Okay, and then in our arrow, we're going to specify anything that's under owner's equity. We're going to do a little explanation for, so that when we complete our income statement, we'll be able to go in and pick out exactly what that transaction was for, and that was just for a service fee. Okay, in F, we paid office rent for February, $600. Okay, so when we're analyzing and picking out our two accounts that were affected, we paid. So if we've paid, that means cash has been affected. So we're going to go in under F and put a minus $600, because when you pay, your cash goes down. All right, office rent. Office rent is something we pay every month, so that is considered an expense. So we are going to enter $600 there, and see how that expenses and drawing decrease our owner's equity, and capital and revenue are our two increases to owner's equity. So we have to specify what the $600 is for, and that was for rent expense. Now in G, we paid our phone bill, $64. Same transaction. We paid it, so cash goes down, and it was for an expense. Expenses are paid out to help you earn your revenue. So expenses are always, they're kind of a necessity. These are the items that we have to pay out to help us earn our revenue. So if we're going to have a telephone in our business, we have to pay our telephone bill. And if we're going to have a place of business, we have to pay our rent. All right, in H, we withdrew cash for personal use. Okay, if the cash went out, then our cash has gone down. So we're going to subtract that from our assets. And remember the definition of when the owner takes cash out of the business for personal use, that is considered drawing. Okay, it is taken out of the business, but it is not for business purposes. It's for the owner's personal use. In transaction I, we've performed services for clients' own account. Okay, so the two things we need to record are the fact that we perform the services. So we're going to go over and put that in our revenues. We'll call that service fees. And so we've performed these services, but how did we collect? There's only two ways. We either received cash or we're going to send them a bill. And the own account here is telling us we didn't receive cash. We're going to bill that customer. So we're going to enter this into accounts receivable. Now accounts receivable, if you remember, is an asset. So we're going to increase our assets there. But just remember that $750 does not represent cash like these others. It simply represents accounts receivable. Okay, let's look at J. We paid wages to part-time employees. We paid them, so we're going to reduce cash by $1,200, and then wages is an expense, okay, a cost of doing business. So we're going to enter $1,200 there, and be sure you specify wages expense. Okay, in transaction K, we've received cash for services performed on account in transaction I for 400. Okay, notice that we're going back to this transaction here where we're billing our clients for our services. So what's going on down in K is that these clients have paid us a partial payment for the service that we performed up in I. So two things are going to happen. We're going to increase the cash for the amount of cash we received, and then we're going to decrease accounts receivable to reduce the amount showing on our books that our clients owe to us. So we're going to enter a positive 400 for the cash portion and then a minus 400 for the accounts receivable portion. Now that we have all our transactions entered, we can balance out each column. So if I begin with the 32.2 and add and subtract as we go down, we're going to get a total of 31,586. We'll bring down the 5,200 in liabilities, the 27,000 in capital, the 1,000 in drawing. Revenues are going to equal 2,250 and expenses are 1,864. Okay, now we need to make sure that our accounting equation is in balance. So we already have the balance of our assets. We'll bring it down to this column. Liabilities are 5,200. Capital's 27,000. Drawing is 1,000. Revenues are 2,250. Expenses are 1,864. Now when we're getting our total liabilities and owner's equity, you have to be really careful. So what we're trying to do right here is add up the right side of the equal sign. Okay, so we're going to take 5,200 and add 27,000, subtract the 1,000 in drawing, add the revenues, and subtract the 1,864 in expenses. And when we do that, we get the 31,586, which is the same amount as our total assets. So liabilities plus owner's equity do equal our assets, but it's very important that you remember to subtract drawing and subtract expenses because these two reduce owner's equity. So now we'll check our work, and it looks like everything looks good. So we'll go on to exercise 2.5. Okay, so here we are going to classify our accounts once again as assets, liabilities, or owner's equity, and then we're going to indicate which financial statement that the accounts belong on. Okay, so we remember that cash is an asset, and the financial statement that reports assets is the balance sheet. Okay, so the balance sheet is the only financial statement that contains an asset. So you'll just have to remember all assets, liabilities, and owner's equity is shown on the balance sheet. You can kind of remember that because those are the accounting equation elements. Assets equals liabilities plus owner's equity. So those are the accounts that are going to show up on the balance sheet. And typically, with one exception, an account only shows up on one statement. Okay, so rent expense. Rent expense is obviously an expense. It's one of our owner's equity accounts. And expenses only show up on the income statement. The income statement is revenues minus expenses equals net income. So all expenses show up only on the income statement. accounts payable. That's what we owe. So what we owe is called a liability, and liabilities are on the balance sheet. Assets equals liabilities plus owner's equity. Service fees. Service fees are revenues. So anytime typically you see the word fees, the textbook is referring to a revenue, something that's going to be earned by the business. It's not something we pay out, it's actually something we earn according to this textbook. So revenues are shown only on the income statement. Supplies. Supplies are assets because they provide future benefit to a company, and all assets are located on the balance sheet. Wages expense is an expense. All expenses are on the income statement. Drawing. Okay. Drawing is one of those owner's equity accounts, so we're just going to list it down here as owner's equity. And drawing is shown on the statement of owner's equity. The statement of owner's equity is formatted beginning balance plus net income minus the owner's drawing will give you the new capital balance. So drawing only shows up on the statement of owner's equity. Okay, now we have capital. Capital is also one of those 4 accounts underneath owner's equity, and capital is the only account that is shown on more than one financial statement. Capital is on the balance sheet. When we report assets, liabilities, and owner's equity, under owner's equity, we're reporting the capital balance. And it's also on the statement of owner's equity, because in the statement of owner's equity, you're reporting the beginning and ending capital balances. So we're going to choose the 2 financial statements for capital. This is the only account that will have 2 financial statements. The next account is prepaid insurance. Now, prepaid insurance is insurance that we've paid in advance. Typically, insurance companies want you to pay their premium in advance, so that means that we're going to get future benefit from that payment. So prepaid insurance is an asset, and all assets are on the balance sheet. Accounts receivable, remember, is an asset. That's what our customers owe us that we expect to collect on in the future. And so assets are shown on the balance sheet. Okay, checking the work, and it looks good. So let's try exercise 2.6. Okay, we have statement of owner's equity reporting a net income. And we're going, I assume, to complete a statement of owner's equity here. It says Betsy Ray started an accounting service on June 1st and invested $20,000, so you know that went right into her capital account. She earned $10,000 in net income for the month and withdrew $8,000. Okay, so over on the statement of owner's equity, we're going to start out with the June 1st beginning capital. Now, with the statement of owner's equity, it reports really only capital, the way you got what you started with in capital and the way you got to your ending balance. So the first line will always be your beginning capital, and your last line will be your ending. So you're starting with capital and ending. So now let's tell how we got to our ending capital balance. Okay, we started out, since it's a brand new business, she didn't have any capital. Now if for the month of July, for example, she will have a capital balance beginning, but since this was a brand new company, she's starting from scratch, so she had no capital until she made her investment of $20,000. Okay, so now her total investment is $20,000, and to that $20,000 she has worked all month and added $10,000 in net income. Okay, so net income for June is $10,000, and then she withdrew $8,000. So you'll always subtract out the owner's drawing for the month. Okay, so it says less withdrawals of $8,000. So we are going to get, the next line is the change or increase or decrease in capital. So since our income was more than what we withdrew, we're going to have an increase in capital. If our net income was less than what was withdrawn, then we would have a decrease in capital. Or if we had a net loss and drawing, we would have a decrease. But in this case, we have an increase, and increases are a good thing. Okay, and then our final capital at the end of June would be $20,000 plus the increase of $2,000, and that'll give us $22,000. So let's check our work. Okay, looks good. And on to our last exercise. Okay, now we're going to do a statement of owner's equity with a net loss. So sometimes companies don't have a net income for the month, they may have a net loss. So we're going to look and see how to handle that. So we're starting once again with our beginning capital at 0 since it's a new company. Investment's the same, $20,000, and so her total investment in the business is $20,000. Okay, so it says here her net loss for the month was $3,000. Okay, so we're going to put less the net loss for June of $3,000, and she withdrew $8,000. Okay, so if you look, when we do our increase or decrease, we have a net loss which decreases capital, and then she withdrew $8,000 on top of that, which decreases capital even more. So you're just going to have one huge $11,000 decrease in capital. And so that means her capital at the end of the month is now $9,000. She started out with 20 and it's now 9. So basically what she's done is had a loss and then took $8,000 out of her capital contribution, and it leaves her with 9. So we'll check our work. Okay, so once you get through your exercises, hopefully you will be able to complete your problems a little more easily. So I'll leave those for you to do. Please call or email if you have any questions.